Tejas with me. Welcome to Cryptonite. We took a break for about a month, and we are back. In time for the famous halving that happens every 4 years. So, Tejasvi, can you walk me through what it means? I'm sure we have discussed this before, but we have new viewers coming in as well. So, they may not actually know why this halving happens and what is the funda behind it, and also the economics behind it. Like, what happens to miners right now? Uh,
Yeah, I can
so,
give you like a quick rundown on those things. So essentially, new Bitcoin are created every block, and every block kind of happens approximately every 10 minutes. So a new block is coming in 10 minutes, and you get new Bitcoin allocated to the miner who mined that block every 10 minutes. So the amount of new Bitcoin given to every miner every 10 given to the miner who mined the block every 10 minutes is currently 3.125 Bitcoin per block. Now, this was 6.25 Bitcoin till last night around 2 a.m. Zurich time here, and around midnight UTC. So the idea is till yesterday night it was 6.25 BTC, and that in that one moment at block number 84000000 it became 3.125, which kind of became half of what it was before. Again, if you go back 4 years, even before in the past, in April 2020, it used to be 12.25 Bitcoin or 12.5 Bitcoin actually. And if you go back 4 more years to 2016, it was 25 Bitcoin per block. If you go back 4 more years in 2013, it was 50 Bitcoin per block. So essentially, when Bitcoin started, it was 50 Bitcoin per block. And every 4 years, the amount of new Bitcoins entering the Bitcoin supply decreases by 50%. So for the next 4 years, it will be 3.125 Bitcoin per block, which essentially means that miners have less revenue now from the blocks that they mine. So let's assume you're a miner, you've bought a bunch of hardware, you have a bunch of deals with utilities providers for electricity, you're running this data center operation, mining Bitcoin 24 hours. Your goal is to make money out of this operation. And that money the new money that comes in out of Bitcoin has kind of gone by half now. So which means that miners' revenues will go down, which typically should reflect the idea that the unprofitable miners will shut down and go home, and the profitable miners will stay back, who have cheaper deals with electricity providers, cheaper cost of hardware and everything. And eventually, as more miners kind of leave the system, uh, Bitcoin will become harder and harder to mine because number of operations per second has like some requirement. But Bitcoin is kind of the smart enough, or the kind of the innovation in Bitcoin is that as the hardware power keeps reducing because miners are going and doing other things, they're kind of leaving the business. Bitcoin's mining becomes easier and easier. So essentially, the 10-minute per block kind of continues forever. And if it becomes more difficult, miners leave. If it becomes more profitable, miners will kind of come in. So right now, the assumption is that the miners some of them will leave because the profit per block has gone down. And this is, in some circles, considered to be a fairly serious threat to Bitcoin itself. Because the idea is every 4 years, if it keeps reducing and miners are not incentivized to stay back and mine, then Bitcoin will suffer grave consequences. Like, governments will come and mine on the side because it's cheaper to mine. They will disrupt the system. Bad actors will disrupt the system. Generally, it's called Bitcoin's security budget in some circles. I don't like that term, but it's used fairly commonly. So the idea is Bitcoin security budget is going down every 4 years. And is that a bad thing? My claim is it's not a bad thing, because eventually Bitcoin will become valuable enough that even 3.125 Bitcoin every block will be enough to pay for your hardware and pay for your electricity costs and more. You can make profits with it as well. So if the Bitcoin value goes up, it automatically solves the problem because your electricity is priced in dollars, but your Bitcoin is going up in value. The other way of making money for miners is they will eventually also have fees for every transaction. And if every transaction becomes more valuable, then they will get more fees from the transactions themselves. So right now, typically the fee split is around, I would say, 80-20. So every block, 80% is by the new Bitcoin emitting from the block, and the 20% is from the fees. My hope is that it will become the reverse, which is 20-80, where 80% will be dominated in fees. And when that happens, miners will still be profitable and things will continue as they are. Now, there are a couple of signs that point to this direction. So in the last, I would say, a year or so, there has been a lot of research on building more and more powerful smart contracts on top of Bitcoin. And these smart contracts eventually will pay more fees because they will subsume more economical activity. So these smart contracts will be more powerful, more expressive. They will have more uh, economic fundamental building blocks built on them, like a decentralized exchange or a perpetuals market or something like that. And those will, by their nature, provide more volume and more fees. And when that happens, fees will go up in the base layer, and that will be good for everybody. So there is some silver lining here, which is the research that's happened in the last 1 year, where we have a clear trend that more transactions with higher economical density are coming into Bitcoin, and that will make this transaction, this security budget issue, not as serious an issue as it is made out to be.
So, what is the break even for Bitcoin mining right now?
It's hard to guess, by the way, because everybody has a different margin. So some folks in the US tend to. So the miners in the US, some of them are public companies. So like Marathon Mining, Riot Miners, these guys are publicly listed, Nasdaq listed companies. So they have to give out their statements, and you can actually go through them and see what their cost of electricity is, cost of hardware is, and they are operating in the margins right now, in the sense that they are not super profitable. Uh, but again, Bitcoin's price going up to 70K helped a lot, obviously. But with the halving coming in, it will definitely make it harder. But then the narrative is also that because the halving has happened, which means new Bitcoin entering the market is kind of gone down, and old hands are not selling, the price of Bitcoin has to go up because there is an insatiable demand from ETFs, from institutions, from other players, which is, of course, the main reason why I would say we are all excited about it at some level. Uh, that should still make it good for them. But again, this is the miners in the US where the statements are kind of clear. But there are miners in Kazakhstan, in China, in Russia, in Berlin, in Belgium, in Iceland, in all parts of the world, and there's no way to figure out what their cost structures are. So we see that difficulty has been going up all this time. Difficulty is a technical term here, which means the amount of hardware it takes to mine one block has gone up over the last many years, and it kind of comes down a little bit once in a while, but it's kind of a mostly going up. Left and high is right, and high is the hockey stick or whatever. Not even hockey stick. What is it called? Like just a simple line kind of going up. And if that is of any indication, it means that their costs are going lower and they are profitable. I don't know how. So my knowledge here is fairly weak. I don't know what the margins on average Bitcoin miner is. But for those interested, you can definitely check out the quarterly statements from Marathon and Riot, who are two big miners in the US, and they give out their cost of hardware and everything else on their statements.
Right. I just did a quick Google search. It says, it can vary anywhere from $7,800 to $25,000 to buy one Bitcoin. So if Bitcoin is trading at 60,000 and above, so I think we're a long way away from from that having an impact on on profitability, so to speak.
Yeah, but right
But
now
yeah,
it halved, right? I mean that number that you're reading is per block, how many Bitcoins they mine, and what is the profit, what is the price they pay per Bitcoin. That has gone up by 2, right? Like yesterday. So the margin has been cut in half already. Not cut, margin has been cut in half. The revenue has been cut in half. So the margins have come down even more because the fixed cost has not gone down, right? So that number will revise pretty drastically over the next couple of weeks.
got it. And there's also competition now from these AI guys, right? So they have these massive NVIDIA chips, power hungry beasts that they need to power. And I think Sam Altman was pointing out that this is the new beast in town. So giving competition to all the low power regions. So what would you rather do, like mine Bitcoin or set up a data center like a cloud data center, allowing you to train AI models? I mean, that's a big open question. What is
Yeah, it
more
is.
lucrative?
So I would imagine it's also both. So the Bitcoin mining as a demand doesn't care about whether you're up, down, whether you are reliable, unreliable. It doesn't really matter. It's a memoryless process. when I say memoryless, I mean in the technical kind of Poisson sense, right? It doesn't matter whether you've done operations a couple of minutes ago. The operation you do right now, this 1 second counts. In AI training, it's not that obvious. In AI training, your reliability matters. So if you run a job for training a model and the job kind of crashes halfway through, that's not going to work for you. Some of it can be incrementally stored. You have incremental training available, but you have to do a lot more software engineering to make it work. So as a demand, from the demand side, AI jobs are a bit more, I would say they have higher standards. So they won't go into any and every data center. They will be much more, I would say, conscious about where they go. They need like reliable hardware, reliable uptime, reliable quality of service. So I'll give you an example. So in this crypto casino right now, the AI chips marketplace is like a big sector. So basically, on the one side you have GPU vendors, and on the other side you have AI training jobs. So this marketplace is now being kind of constructed on crypto platforms in three major ways. So one is a startup called io.net, which raised I think $1 billion. Sorry, which raised at a valuation of $1 billion. It raised around I think 200 million or something. So they're very well capitalized. They have access to like I don't know like 40,000 GPUs across various parts of the world, and they want to connect them to like AI training basically. Then there is a company called Akash Network. So Akash is a slightly older player, 2 years maybe or so, 3 years old. They also have a marketplace of GPUs which they allow you to use for AI training. Then there's another company called Render, Render. Render used to be a company where the demand was for rendering. So you know that rendering a high definition video is also like a very GPU hungry job. So if you want to transcode some videos for like IMAX movies or whatever, it's a lot of GPU work. So Render used to be, their business model used to be that they would allow you to do video transcoding. But of course, that was before the AI boom. And now with the AI boom, you can repurpose the same GPUs to do AI jobs. So there are these three big marketplaces, which are a good example of how it kind of plays out. And from the demand side, I have heard from very reliable sources that they are kind of pissed about running jobs on any of these three clusters because the reliability is not there. So they get a contract. For example, you go to Render and you say, I want 100 GPUs for 36 hours. And you kind of sign this contract with a vendor and you start this job. And the vendor kind of is like somebody you really can't trust. He will disappear after like 24 hours. And then you have really nothing. So you have to have some crypto economic incentives to make them kind of stick around. And these incentives are not always as strong because the token price fluctuates and overall it's not as reliable. If you get captive hardware where you say that you are the one who owns the hardware and you will then kind of train AI jobs and you are looking for cheap electricity and go there and do it, it's okay. But that job has to be like, it's kind of end-to-end integrated with you. But if you are like a Bitcoin miner, all you have to do is set up like this hardware, which is kind of commoditized, and you can go up and down depending on whatever you want to do. It's completely like it's a memoryless job. It doesn't care. It's a very, so I would say in the hierarchy of things, electricity is better spent for human whatever flourishing. Second would be AI training. Third would be Bitcoin. In that order, like that would be my preference of how you want to use it. But human flourishing needs much more higher standards. You can't have blackouts and stuff. AI training, I think, has slightly lower standards, but it still has standards. Bitcoin mining is the one with least standards, right? It doesn't care whether you are up or down. So, which is actually interesting because that is the kind of demand that some vendors want because they cannot afford to have the quality of service that these other higher sources want. So, in my opinion, I think it'll shake out nicely because anybody who can give better quality of service will go for AI training, which is fine. And I'm of the belief that more electricity usage is a good thing. So I will not begrudge either AI training or Bitcoin mining for electricity usage. But there are some noises made by government regulators about AI training as well, as to how it is taking up all the electricity in the world. It will consume all of US electricity by 2050 or some obscene number like that. Yeah, that's a usual drumbeat from kind of what do you call them? Luddites is the word, I guess.
Yeah, not just Luddites. There is. It's fascinating how strong the anti-nuclear power lobby is. It's the cleanest source of energy known to man. They've already invented, sort of like small-scale reactors that doesn't need like massive, $10 billion outlays and that kind of stuff. You can have one at the outskirts of a city and use it to power it. So there's a lot of advances there, but they fail to sort of encourage it or boost it or anything of that sort. They keep blocking nuclear power at every stage and keep complaining that new technologies are consuming more power. But that has always been the case, and I think I pointed this out, I think a couple of episodes before, that after nuclear power, after the bomb, and they figured out how to use nuclear power to generate electricity, like in the 3 Mile Island and all that. So at that point, scientists were thinking that what's the point of even metering electricity usage, because pretty soon we are going to have all the electricity you'll ever need. We'll have surplus electricity. And they were actually encouraging the industry to come up with new electrical appliances. Like, why do you need an electrical stove when you have a gas stove, right? But those inventions were based on scientists' projection that it doesn't we are going to be in an energy abundance world. But thanks to these idiots, that never played out. And hopefully, they'll see the light at the end of the tunnel, and actually go for these kind of solutions. So that's one thing. And yeah, I mean, AI training, I, the one thing I don't get is people project, like 3 points, draw a line and extend it forever and say this is always going to be the case. But everything I've experienced so far in my life when it comes to software is that it'll obviously get more efficient, right? But by the time it gets more efficient, people would have come up with more use cases for it. So so you're never getting the benefits, the cost reduction in it, getting more efficient, but you're getting more productive. So so focus on that rather than coming up with the idiotic ways of shutting down innovation, right? So that's my 2 cents there.
And also, I think the idea of projecting it without understanding how it'll all have natural kind of caps in terms of demand is also like not
Yeah.
very well understood by most people. I think they will assume that the demand will continue forever without like alternatives emerging, without the cost kind of playing out, without the markets playing a role. So there is just, yeah, it's just it's how it is, and it's easy, it's clickbaity, it works. People will have, and people need something to get scared about. So it's always a good thing to have a boogeyman who's who's causing other people to get rich. So it's a perfect storm in some sense.
Yeah, absolutely. So that's about Bitcoin. So what's going on in the rest of the world? There's so many shit coins that got, or meme coins or whatever, on the Solana blockchain recently. There's all
Yeah.
different plays on
Yeah,
popular.
Geo Borden was the big one. Geo Borden is a misspelling of Joe Biden, obviously. Geo Borden came out of nowhere as a part of a larger trend of crypto coins. They're all kind of so-called meme coins. Their essential job is to do nothing, essentially. So the idea is you send money to a single address somewhere, and that guy will mint some random tokens and he will send it to you. It is really the most egregious, not egregious. It's unbelievable that it works. That people are actually willing to send random money to real money to random people and expect some token back, and the token will have value over time. So it kind of became completely like a frenzy in the Solana world, because Solana by design makes all transactions very cheap to the point where it's kind of meaningless to pay any fees there. It's like the fees is almost like 2 cents or 1 cent or whatever, right? But that actually caused such a surge of meme coins of all sorts of typos of names of people, racist tropes, sexist tropes, you name it. Think of anything which can be clickbaity, and there was a meme coin on those lines. And those are essentially like the NFTs from the previous era, and they became very popular. And the sad thing is, along with their popularity, they also took down Solana, the blockchain itself. So Solana, the blockchain, is structured slightly differently than Ethereum or Bitcoin. They have an idea where, give me a second. Yeah, so their idea is that they are so in Bitcoin and Ethereum, transactions enter like a common peer-to-peer network, and they're picked by like a miner or a validator, and then they're assembled into a block, and the block is kind of finalized. In Solana, it doesn't happen that way. In Solana, everybody knows who the next validator is or next miner is, and there's kind of a schedule around how the miners kind of go around in turns. So you actually send a transaction to the miner himself directly. You know who the miner is, so you don't send it to this peer-to-peer kind of amorphous network. You send it directly to the miner. You make a HTTP connection or a TCP connection to the miner, and you send it directly to him or his computer or their computer. And so the computer has to open a bunch of ports and kind of accept these incoming connections. So Solana, the actual C++ or Rust or Go binary which was running, actually their networking stack collapsed under this load.
Oh, yeah.
And and that was kind of crazy because imagine if somebody's trying to open like a million TCP connections to you, right? And this is like a DOS attack on that particular server. And these validators are not geared for such incoming loads. For example, if you go to google.com, the google.com IP that will be sent to you will be hosted in some server with like some bulletproof technology behind it, right? They will know exactly how to throttle specific IPs. They know how to throttle specific gateways. They know how to like open billions of ports, virtual ports per machine. They know all those tricks. But a Solana validator is like a peer-to-peer network kind of a client. And if you send it like 10,000 ports, port open request, it kind of collapses under the load. So Solana collapsed at a networking level first. Then it collapsed at a consensus level or like at a transaction level where the validator, who is the leader currently, he gets like 10,000 transactions and he has to like pick 30 which are valuable or whatever. And that algorithm also failed. So there was networking failure, then there was actual code failure. And if you look at Solana failed transactions over the last, I would say 3 weeks or 4 weeks or so, it is like 20% success transaction succeeded and 80% failed. And that became a big meme in itself, to the extent where, and ironically enough, the failed transactions are also noted on the blockchain. So there was a currency that came up called ORE, O-R-E, which would be minted only if a transaction failed. So they were incentivizing failed transactions on Solana. So the idea is you can mint an ORE if you are able to send 1,000 failed transactions to Solana. They are doing a proof of work on Solana failure, if that makes any sense to you. So proof of work is basically you're doing hardware work to get Bitcoin, right? Here the hardware work is prove that you are sending failed transaction to Solana. And that will let you mint these ORE coins. And that kind of took down Solana even more because now there is incentive to spam, which is like purely financial, not even like some speculative financial, right? So it was like completely nuts. So Solana is still struggling. They have updated their networking stack now. They changed the implementation of the TCP network port connection acceptance thing. There was a huge thread on their GitHub on this. They're also working on the consensus algorithm to kind of make it more nicer. Essentially, eventually, till they make the fees more commensurate with the demand, it's not going to work. So Solana's fee structure is completely broken, and that has to be revised. So they're working on it, and hopefully it will get fixed. Till then, Solana is in. I mean, they have always been in firefighting mode. Solana is kind of a Web 2 equivalent Web 3 project. Even move fast and break things, and generally the kind of the attitude that we'll fix problems when they come, and everything has an engineering fix. So Solana is a kind of a Web 2 ethos project, right? And that's a good thing because they kind of come from the engineering first mindset. They're not philosophers, they're not idealists, they are like engineers. So they will take it as an engineering problem and they will solve it. So will it work or not is a kind of different question. Because sometimes some philosophical questions might not have engineering solutions. So we'll see how it goes. So that's kind of the Solana story. Meme coins are the trend. So you can buy some Geo Borden and you can retire on them, maybe.
I mean, the biggest problem with all these fees and throttling and all that is, how do you know one transaction is more important than the other, right? So unless at a fundamental level you can differentiate between a meme transaction versus a quote unquote serious transaction, then even if you set the fee, then you're just throttling the more important transactions.
Yeah. This is actually this debate is playing out in the Bitcoin land quite seriously, by the way. So there they call it spam versus not spam. So for them, everything which is pictures, NFTs, whatever, anything which is not financial transfer of value, for them is a spam. Or for some category of Bitcoiners, it's spam. And for some, it's not spam. As long as it's valid data, it's not spam, right? So this debate is very strong right now in the Bitcoin community, with neither side kind of winning in some sense. Here's the problem. And the problem is you really cannot have a preordained definition of what is spam. So essentially, if people pay for it, it is not spam anymore. The question is, can they pay for it? And will they pay for it forever? So some people like me, we assume that eventually the fees will raise to a point where these guys will be priced out. But the thing is, the for fees to rise, there has to be a bound on the supply of so-called block space. So if your block space is limited, then the fees will go up to match the volume. So in Bitcoin's case, it is limited. Bitcoin's case, block space is limited to 1 MB every 10 minutes, approximately. And that will eventually, that is set in stone. Because of Bitcoin's magical difficulty adjustment, the 1 MB per 10 minutes is set in stone. So there is a demand, there is a supply constraint, natural supply constraint. So that means that if the demand goes up, then fees have to go up. And market will play the role there. In Solana, though, what they did was they said, we will increase the block space a little bit to accommodate for these transactions. And again, it's not very kind of obviously increased. They have some limits on the compute units and all of that. But the thing is, the fees were kind of set initially so low that they were kind of spammed away to glory. But now, even with that spam, the prices are going up, as you should expect. But we'll see how it goes. I think eventually the physical cap on the block space is what's going to save us. And spam will be there, but one man's spam is another man's whatever, gold or whatever, right?
Interesting. So you mentioned Athena. What is that about?
Oh man, Athena has been causing a lot of grief in the crypto DeFi community over the last 4 weeks or so. So Athena is this very deeply venture-backed project, which tries to tokenize the so-called basis trade. So I am not an expert on the basis trade itself. So maybe you can explain that in a second using a TradFi example. But I'll tell you what I know. What I know is essentially what Athena does is it buys Ethereum spot and then it sells ETH futures contract at a higher price. So when the future contracts matures, it can sell the spot and kind of deliver the futures product or whatever, the spot equivalent. And it pockets that basis difference because the futures are trading at a slightly higher premium. It gets that particular basis difference. And the other thing is because it's holding spot ETH, it can actually also stake the ETH in regular Ethereum staking and get the 3.5% yield from Ethereum staking as well. So it can juice its yields with the staking rewards, but the yields typically come from the difference in the futures value and the spot value. Now, what they did was this would be like a normal hedge fund if they did that just as an entity. So you are an entity, you hold ETH and you do this, it all works fine. What they did was they made this into a smart contract. And the smart contracts holders are represented by tokens of the smart contract itself. So you can buy the Athena token, which represents a share in this particular trade. So they are tokenizing this particular trade itself. So that's what they did. And it is a bit controversial because it somehow reminded people of Luna, the failed stablecoin from 2022, which was an entirely different model. They were not doing any sort of futures hedging or delta neutral strategies. They were essentially saying that we have this mythical token or we have kind of this made up token called Luna. You buy this and you burn it and you mint the stablecoin. It was like a very kind of simple perpetual motion machine, and that failed very easily. Here, there is a notion that you have a futures market which is slightly mispriced and you take advantage of that. And of course, the risks are basically your futures market guy the counterparty will kind of bail on you. So the counterparty risk is real. And let's say you are buying ETH and staking it. The staking provider might disappear or whatever. So there are some counterparty risks and you have to price that in. But otherwise, the trade seems fairly elementary and tokenizing it seems fairly obvious as well. So I don't know whether basis trades are popular in the TradFi world and whether those kind of delta neutral strategies have made money for people.
See, it won't work at a retail level, but there are market makers who do this sort of basis trade, and it's a very old thing because see, there's a implied funding rate when you buy futures, right? Now, the question is really what is that fair funding rate. So it can't exceed the risk-free rate by a wide margin, because in the TradeFi world, you can say that there's zero counterparty risk because of a clearing agent in between. So if you have no counterparty risk, and so that that funding rate should not exceed the risk-free rate. So that is usually true in the TradeFi world, because there are people who have fancier hardware who keep monitoring this and doing this sort of basis trades. The question is really boils down to what is a market risk-free rate, right? So you mentioned that if you stake Ethereum, you get 3.5%, but if you just buy 2-year treasuries, you get 5%. So that 3.5% is not all that great when you compare it to Uncle Sam's 5% that you're getting. So I would argue that risk-free rate should at least be the 2-year treasuries. So and plus you layer on counterparty and the general nonsense that goes on in crypto land. So it's got to be a bit higher than that. But it sounds like I have to look at what exactly they're doing, but it sounds like they have settled on this 3.5% as the rate, right? As the what do you call appropriate funding rate for them. Now if you flip it, and so let's say they are they are long Ethereum and they're selling futures, right? Now somebody on the other side is buying these futures. So for them, this is awesome, because uh, especially if they're getting funded at 5%, which is the TradeFi risk-free rate. So here there is an idiot in the zoo who is willing to sort of sell it to you at 3.5. So so why wouldn't I buy this? So for me, it is a mispriced future. If I'm just buying this for for trading myself. So I don't know. I don't think this trade is all that great. But from my experience talking to these crypto nerds, is that they fail to understand that there is a world outside of them, right?
That is definitely
So
my experience as well.
yeah, so maybe it makes sense within the staking, unstaking, and leverage world, perpetual futures, blah blah blah. So maybe in that world this makes sense, but then if you benchmark it to 5% 2-year treasuries, then I don't know what the
So the
potential.
Athena token itself was giving a yield of 27% in the simulations, and it's also it's live now for the last couple of weeks, and it's giving around some obscene amount of yield, which I don't know how it's doing it. Again, they claim, again, this is not yield minted out of thin air, because people have vetted the smart contract. It's not like obvious scam. Uh, Mostly because I think the futures market in crypto is much more. The funding rate in crypto is not the risk-free rate in crypto. That's the problem. The funding rate is much higher because people expect crypto to keep going up, and that makes a big funding rate gap, and that is what they're playing on. But of course, if the funding rate, if the thing flips a little bit, if the funding rate goes negative, then things will become very hairy. So Ethena has a kind of what is called an insurance fund. So the insurance fund is where they cap their exposure. So the insurance fund is, I think, a couple of $1 billion, and if they go beyond that, they don't accept any more deposits. So they have like some sort of a balancing mechanism that lets them do this. The controversy also escalated because Ethereum has a bunch of stable coins. Of course, the classic stable coins are those which are backed by actual dollars or treasuries in some bank in Panama or whatever. But there's one not algorithmic stable coin. There's one crypto-backed stable coin which accepts crypto collateral and mints particular stable coin, DAI. And the DAI governance forum decided that Ethena would be a good collateral for them. So this whole basis trade token, this tokenized hedge fund, would become a collateral to be able to mint this particular stable coin called DAI. And that was a very tricky move because DAI is used in a lot of places in crypto, for example, in lending markets, in other markets. And if this DAI can depeg from US dollar because Ethena blows up, then those lending markets are exposed to their DAI risk. So it kind of became a huge governance forum, cascading decision-making frenzy. So Ethena released their kind of model. Then DAI said they will accept Athena as collateral. Then people who are accepting DAI as a stable coin said, no, we don't accept you now because you guys are tainted. So it was like a kind of a transparent governance cascade. It was fun because you can see it in the open. These kind of things happen behind closed doors in Wall Street, and you can't see them. And you don't know what the decision makers are actually doing and what are their incentives and stuff. Here, the incentives were so clear and so transparent, which was almost refreshing in some sense. But anyway, that was like a DeFi micro circus that happened like a couple of weeks. And right now, I think Athena still is accepted as a collateral for DAI. That proposal went through. But DAI being blacklisted by lending protocols is still under governance, I think, governance votes or whatever. But I thought it was kind of funny to see this whole, you started a carry trade or a basis trade, and from basis trade all the way to some DeFi protocols blacklisting a stable coin, which is such a long way away. I thought that was kind of interesting crypto native construct.
Right. I mean, it sounds like a snake trying to eat its own tail. So because you can take this DAI, pledge it somewhere, and keep buying Ethereum futures.
You can buy Athena with
right?
it. Yeah, that's called looping. So looping is a thing in crypto. So you basically loop. You buy the same thing. You pledge it as, so you buy X, you pledge X and buy Y. You buy Y and pledge X again. You kind of do this, but there is only like a number of times you can do this because there is like a cushion that they don't let you violate. So your overall looping ratio can be as high as 4x or whatever. That's what gives the leverage, right? Crypto is full of leverage games because of this particular looping idea. And these things unwind very painfully for many people. And I know folks in the circle that I move in where people have battle scars, which are quite terrible to see.
Yeah, no shit. So speaking of battle scars, so there was tornado, right? That is, there's a court case going on in the Netherlands, I think, and so while that is going on, I think we've discussed this a few times before. So one of the key things that they're saying is we are not the criminals. Like Tornado is not the criminal because it's open source. It's the users of Tornado, which they might be criminals, but we don't know that. But the vocal supporters of this are all users of Tornado. So and they are all like what, indicting themselves, or what the hell is going on over there? So why are they even supporting Tornado vocally?
So it's kind of a difficult discussion, right? Like if you are a user of Tornado, you might not. I mean, the user of Tornado and the supporter of Tornado are different people, right? So I, for example, support Tornado as a concept for two reasons. One is it's a very elegant piece of engineering. It is truly remarkable. Like the idea of Tornado Cash is mind-blowing. Of course, Tornado Cash was not the inventor of the idea. The idea was invented in Zcash, which is a different protocol or a different cryptocurrency. But anyway, the idea is essentially the same. So the idea is beautiful. So it kind of is worth supporting for itself. And you could argue that that privacy is a right, and people have to be people should be able to protect themselves from governments that want to look at how their transactions are going through, and it's a reasonable thing to think about. And of course, governments will argue back that there are terrorist financing and child pornography and all the other bad stuff that is happening, and these guys are being funded by Tornado. So this is a never-ending debate. Here's the fun part, though. The fun part actually is, with Tornado's case, if it was just pure open source code, it wouldn't have been that bad. What happened was Tornado also had a token called TOR, T-O-R. And if you do a Tornado Cash swap for currency X to currency Y, the TOR token would accrue some value. And the guys who deployed Tornado Cash on the blockchain, on Ethereum, were able to mint themselves a bunch of TOR initially. And that TOR got some value. So they were able to profit from this money laundering, so to speak. Not just as a ideological thing of putting out a code there and kind of hoping for the best, but they had financial motivations to kind of promote it, put a front end to it, make it easier to use. So I think the case is deeper than it just looks. So there is a bit more happening there. I think it's people who want to defend the Tornado Cash developers have to be quite careful about it, because you can defend the open source nature of the code, but defending their motivations of putting a token behind it is not obvious to me. So I am kind of I stop my support at the place where the code ends. So for me, the code base was awesome. So GitHub taking down the code base was pretty stupid. So censoring the code base is completely meaningless. But having financial motivations to run a money laundering service is a bit tricky. So there, I don't know whether it would be an easy thing to support.
Interesting. So is that the same reason why Uniswap got a Wells notice?
Yeah, you could say that. So Uniswap had two things going for it, right? One is, for a long time, Uniswap, the token, Uni token, the UNI token, which is something that kind of underpins the Uniswap protocol, had no value. There is no value accruing to Uni token. Uni token is not required to do anything on Uniswap, the product, right? But eventually, I think in early this year, the governance of the Uni token holders decided to enable what is called a fee switch. So now, whenever you swap an asset A to asset B, a part of the commission is going to the liquidity provider or the market maker on the other side, but a smaller part of the commission goes to the Uni token holders. So that was a big deal. And Uni token is, of course, held by the Uniswap organization considerably. They're venture capitalists and all of the other people behind the scenes, right? So that was a kind of a big scene where now the Uniswap protocol, which is a permissionless, thing which is in the ether, so to speak, somehow has ability to send value back to these particular actors. And then, of course, Uniswap.org runs a front end for this protocol. So there are two separate things that Uniswap is responsible for, the organization. And of course, the SEC is not happy about that. They went behind them. They told them that they're running an unregistered exchange. And if you're running an unregistered exchange, it means that you have not verified all the assets listed on your platform. And Uniswap has a ton of long tail assets. Like, the long tail is really long there. You have so many random assets on Uniswap, it's not even funny, right? Like, it's easy. You can create a token and put it on Uniswap without any problems. No registration, no filing, nothing, right? Obviously. Now, are you the problem? Are you the bad guy here if you do a token and just put it up on Uniswap? Or is Uniswap the bad guy who should vet the token? They will claim that, again, here's the tricky part. They'll claim that they can only, as an organization, enable the fee switch. But they really, from the smart contract perspective, have no right to stop any token from listing. So they are not responsible for all that unregistered listings happening. But if the unregistered listings happen and they trade, they are happy to take a commission. So does that make them a bad actor? It's hard to say. So anyway, the notices come. Uniswap has deep pockets. They have lawyers. They will go behind it. And the SEC will have to be careful because they have already lost to Ripple, which was a very bad defeat. And Ripple is, I think, to be very frank with you, Ripple is a much, for the lack of a better word, a shadier currency than Uniswap. Uniswap is a legit protocol with legit, for the lack of a better word, backers, legit ideas, legit philosophies behind it. So I could kind of defend Uniswap if you put me to the gun, right? But defending Ripple would be much harder. And SEC lost to the Ripple. The SEC lost to the Ripple Foundation. So they might lose to Uniswap. They might lose to Coinbase. SEC is gonna find it tricky now. I don't know why they're going after Uniswap. They could have gone against so many other, I would say, worse players. But they chose to pick up the marquee project in the marquee blockchain. I don't know. I don't get the strategy.
Right. I don't know. I don't know who drives these decisions as well, because most of the time, if they, in the real world, in the TradFi world, it's very rare that anybody goes to jail for these SEC violations. The only set of criminals that they've been able to send to jail are insider traders, because they have a legit way of scanning for all these insider trades and getting the FBI involved and putting them in jail. So it's a steady pipeline that sends people to jail for them. But outside of that, most of these things end up in fines. So I don't know what is a big deal in going after Uniswap. They may be just looking for a payday at the end of the day. It may not actually result in a court case or anything. So let's see
they've
how it
also
plays
settled
out.
they've also settled with a bunch of people, right? I mean, SEC has settled with a bunch of protocols and a bunch of other teams. There was a Telegram, I think they settled with them. There was another Messenger, I forget the name. Messenger, it used to be like a messaging platform, like a social media platform, and they launched their own token. And the SEC sued them. They settled with them. They settled with Kim Kardashian or Jay-Z or somebody. They settled with a bunch of people for crypto violations. So yeah, even here they're looking for some sort of settlement, some sort of thing, payday, whatever. But losing will be very bad for them. That's the problem, right? If they lose, it gives a lot of immunity to a lot of other shitcoin projects, and that's what I'm unhappy about. They should really focus on going behind the bad actors and not, I mean, the really bona fide bad actors. And it's kind of weird to say in crypto there are bona fide bad actors and they're kind of shady semi bad actors. So Uniswap, I would call them in the middle category. They're not completely like, again, these are all very very difficult demarcations. So I don't want to be on record saying whatever, right? So
Yeah. So I think the last item on the list is Babylon. What is that?
yeah, because we had this kind of idea that we will have some innovation section every crypto or Cryptonite episode. Are there new innovations happening in crypto? Of course, we heard about all the Bitcoin halving was set in stone in 2009 by Satoshi himself. Uniswap, yeah, sure, SEC regulation. Ethena, sure, basis trade. All this usual stuff. So Babylon is actually much more fascinating. So here's the fun part. And the fun part is Bitcoin doesn't know about the rest of the world. It operates in its own insular ecosystem. So if you are kind of not a part of the cryptography and the cryptocurrency involved in Bitcoin, you're not kind of you're kind of Bitcoin doesn't really care about you otherwise. So you might be doing other operations elsewhere, and if you want to kind of reflect it on Bitcoin, you have to like do a transaction, and the transaction has to be respected by the protocol. So what Babylon does is Babylon has a way of making a cryptographic primitive where if you sign a wrong transaction, your public key will your private key will get exposed. So the idea is, let's say you're a operator and people deposit funds into you, and your job is to give back the funds when people ask for it. I'm simplifying this quite a bit. There is a lot of technical complexity here. And let's say somebody asks you for a refund and you don't give it back to them. You sign a wrong transaction giving back the refund to yourself. Somehow this can enable the Babylon protocol to reveal your private key to the world. And if your private key is revealed to the world, your own balances will be in jeopardy. So they have this kind of primitive they have invented, which again, this is not as simple as it sounds, because forcing you to reveal the private key means that you have to make a transaction which kind of shares the nonce or some cryptographic entity, which is not common, which is not like somebody will not do it automatically. So forcing somebody to do that is not easy. But anyway, the general idea is, despite 14, 15 years of Bitcoin being there, people are kind of coming up with innovations at the base cryptographic layer, where you can kind of play with public keys and private keys and kind of come up with cryptographic incentives that will ensure that you do the right thing. So if you do the wrong thing, your cryptographic key will get exposed, something like that, which I thought was fascinating because it's not an obvious, it's not an obvious thing to do. The technical details are still kind of tricky. I try to understand this primitive. It's not very obvious to me how they do it. The paper is hard to read. So, but I thought it was interesting to kind of call it out that there is like innovations happening in the space even now, which is the cryptography was written in 35 years ago, and Bitcoin itself is 15 years old. And even now they're coming up with cryptographic constructs which are kind of still innovative, which I thought was nice.
It's interesting, but so what it works as some sort of a purse.
Yeah, so it basically it lets you become like an operator in the middle. So what happens is, if you're an operator in the middle, you can accept Bitcoin transactions, and then you can kind of mint another token on the side. You can basically have another ecosystem separately, and that other ecosystem will enable smart contracts or whatever. It'll do its own thing. But if you want to leave, you are not at the mercy of the operator. The operator has to give you back the money. So it kind of forces him to do the right thing. And right now that's not easy. But what happens is, if you put money into like a Bitcoin ecosystem, like let's say there's an operator in Bitcoin who takes your fund, there's no way for you to force him to give it back to you, because he will never sign that. If he wants to censor you, or if he wants to blacklist you, he can do it. In Ethereum, that's not possible. In Ethereum, you can force a smart contract on chain to give back the money to you. You can write those kind of second layers on top very easily. In Bitcoin, writing those second layers on top, where you can trustlessly exit the system, is not easy. And people have been trying to do it for the last 14 years and not successful. And Babylon might be the first one which somewhat works. I have to still read about it. I'll have more about it later. So this whole Bitcoin layer 2 ecosystem, where you can put money trustlessly and take money out trustlessly, and taking money out is the hard part. Because the operator has to kind of let go of the funds, and they should be forced to let go of the funds, which is not easy. It's like saying that you have a bank which is guaranteed to give you back your money. That's not a thing, right? We don't know such a thing. So that's what
So
they're trying to build.
yeah, so so I have a general observation, which is taking money out is generally a problem with crypto. So not a day goes by when for example, Binance will say, oh, we have some problem converting to dollars,
Exactly.
but
Exactly.
you can convert Binance stable coin. So
Yeah,
what the
by
hell am I going to do with
BUSD.
Binance?
If you want,
Yeah.
if we'll give you BUSD, take it.
Yeah, and in some, I think in some countries they only do that. So initially they accepted dollars, and but now if you want to exit, you have to exit through BUSD. So
Yeah, yeah. No,
some
this is
nonsense like
it mirrors the regular world, right? I mean, in many parts of the world, like if you bring in dollars to India and you take Indian rupees, then the Indian rupee authorities have to let you take back dollars, right? Or the market has to exist elsewhere, and the market has to be supported. The Indian rupee market has to support that. I mean, there's how it works, right? So I think the same idea works here, and that's why if you have a cryptographic guarantee that you can take your money back, even in that ecosystem of Bitcoin, which is a insular ecosystem for what it's worth, I think it's still pretty interesting. So that's where
so. How
I think it
does
is.
staking solve this problem? Because they
How
give
will
you that stake ETH,
Yeah,
right?
yeah.
So can I give back that staked
No, no, no.
ETH and
Staked ETH is a trusted system. So Lido is the organization that gives you this staked ETH. So you put ETH into the Lido smart contract, and you mint staked ETH. So we staked ETH is a regular token which is universal in the ecosystem of Ethereum. The Ethereum you deposited to the Lido smart contract will be used in staking of the protocol itself. But when you want to remove back the money, let's say you want to give ST ETH and get back ETH, the Lido multi-sig has to approve it. And Lido has a multi-sig of 15 people, and 7 of them have to sign that transaction. So it's literally like a trusted system. Like that's exactly how it is. And that's what I was telling you, that a way to force the money out cryptographically is non-trivial. And in Bitcoin, it's even harder because it doesn't even support smart contracts. So in a smart contract, you can say that let's not make it a multi-sig. Let's make it a guaranteed thing. You put ETH, you get this. You burn this, you get ETH back. That contract can be written in Ethereum pretty easily. But of course, they don't write that contract because they want to control the funds, they want to control liquidity. There's a whole bunch of things. So,
got it. Wow. So that's been an interesting
hey,
session.
crypto continues to deliver. At least the entertainment value, right? So,
Yeah, I know. There's something or the other always going on over there. And I don't know if you've seen this. So there's a recent paper out where Nandan Nilekani was one of the authors, basically saying that they're constructing a financial network, like an
oh yeah,
online
I know what it's called.
across
It's called
countries.
what is the name of the network?
I forgot. I'll mention it in the show notes.
Yeah, yeah,
So
I know what it's called. It's got a name which is kind of yeah. Is it Open Credit Establishment Network, OCEN?
yeah, sounds like
Yeah,
something
it's
like that.
OCEN. OCEN is the name. Yeah, yeah. I know the consulting the developer shop that works on it as well. I had actually looked at them pretty deeply like back in the day. There is a company that works on this, which is like the Ocean Protocol. I know about this. So what is the question again?
So, you mentioned about financial like freedom and all that stuff, right? So the rest of the world is actually going in the opposite direction. So, so you guys, so
Hey,
crypto
that's
is like hanging on to this utopian thing, like saying, okay, I can be my own bank,
yeah,
but the
and
rest of the
also
world is like
you
towards
you let
tighter
free
integration.
markets decide the price and stuff. Yeah, crypto is the last bastion of laissez-faire finance, man. That's what it is.
Yeah. All right. So with that, I think we'll wrap up this session. So thanks for coming online and sharing your thoughts. So we'll try and do this again next month. But we have some travel schedule and all that, so we'll work around that.
Yeah, let's figure it out. All right. See you
All
guys.
right. Bye.